With stocks at all-time highs, where are the opportunities to make smart investments? Well, to find out, I'm talking with Jay Hatfield of Infrastructure Capital Advisors. Jay, welcome.
Thank you.
So in 2023, the S&P was up 24%. You're forecasting the S&P gains an additional 10% this year. Why the optimism?
Well, just like last year, we thought it was pretty simple. You had a situation where we were not likely to have a recession. We were just talking about it, that really recessions are created by housing and autos. Those are very strong, partly because of the pandemic. And so if we're not going to have a recession, but the Fed is going to pause, it's pretty obvious that that's going to be very bullish for stocks. Now, it took a little bit longer than we thought, but this year is even easier because we're definitely going to have rate cuts. We don't know exactly when, but it's going to be super bullish when it occurs. So we think strategists are being way too conservative. Most of them have targets right around here. We're at 5,500, and frankly, that's really more our floor than ceiling. We might raise our target if we get a little better inflation data. So we don't fully understand why people are being so negative, but this is a great time to invest or coming out of the cycle, a lot of great opportunities.
You don't think the rate cuts are already kind of baked into the S&P?
The probability implied by futures is 50% cut in March, and we're really saying 10. And so because the Fed is just going to be conservative because they're worried about expectations, and then the debacle with calling inflation transitory when it was skyrocketing. So they're going to be conservative. So I think they're definitely going to cut. The data is getting way better. It's going to continue to get better just because of roll down. So, but there could be a little disappointment around March. So be a little cautious in these first couple months. Because we have run, even this year, we've run a fair amount.
Maybe a little rockiness in the spring, but overall, you're seeing this as a good year for stocks.
Absolutely.
So you're a fan of some investment bank stocks. What do you think people should get into and why?
If we're correct about the market being undervalued and having an additional 10% upside, and maybe even that being too conservative, the companies that benefit the most from bull markets are investment banks. I know this. I was an investment banker. It was 25 years ago, but those businesses really hum when banking's going because it feeds their other businesses. It feeds wealth management, it feeds trading, and of course, if the market's up, their asset management business does well. So investment banks are the most levered to bull markets in the financial sector, and we do think financials are undervalued because in this down cycle, people have been conservative about financials.
Gotcha. So what's your pick?
So we like the pure investment banks. I used to work there, but it was 25 years ago, Morgan Stanley and Goldman Sachs, because they really don't have a lot of the legacy banking business, which is going to be okay, but there's going to be some pressure on net interest margin potentially when the Fed cuts. So we'd rather have the pure investment banks with all those market-sensitive businesses that are going to boom if we're correct about the market. If the market's bad, they will do worse, but so it is a bull market pick.
There are some small cap stocks you're also a fan of. Why do you suggest investors get involved with that?
Well, during down cycles, which we really finished a 2-year down cycle, starting with the Fed tightening, people naturally go to the larger cap stocks. They typically have cash or they're very strong credits. They're liquid. And so what's happened is throughout this cycle, that's been occurring, but small caps have been ignored the whole time. They trade at much lower multiples in the market, about 14 times. They're volatile. And they're interest rate sensitive. So if we're right about rates coming down, they're likely to outperform the market, so even do better than the remaining 10% on our target.
Gotcha. Are there any ones in particular?
Well, we actually non-consensus call like Kilroy. It's a small cap office building REIT. They have some leverage in San Francisco. And what people don't recognize is that people are actually going back to work. In fact, most AI companies are what we call LFO, which is live from office.
Oh, I thought you meant light, funky ones, the band from the 90s.
No, they like, this is like an all hands on deck. So they're not working from home. They're 24/7 in the office. Also, it needs hardware, so you can't do it from home. So we think that people are overstating the work from home phenomenon. And also the fact that AI is booming. Nobody seems to care. They care about the AI stocks, but not the companies that lease to AI companies. So we think that's a good non-consensus call.
It's interesting that AI companies are driving a return to office of actual human work.
Right, yeah, exactly. It is a little bit ironic.
Yeah, well, thanks for joining us today.
Great, thanks, Andy. It's great to be on.
Thanks for watching. Check out more at qz.com.